We have gone over some of the basic concepts of using practical thought while analyzing and buying stocks. Now, I'd like to get into a topic I think it would be wise to take notes on, because we are going to get deeper into the mechanics of portfolio structure and portfolio management, and how investors or rich people make their money work for them. At the end, we will briefly go over what all of this means for taxes. Okay, so I think it's important to state that you must have a written set of rules you abide by to operate in a stock portfolio. This is a system that clearly defines the entry and exit strategy, reasons you will buy a stock, and reasons why you will sell a stock. Also, how can I manage risk? Never deviate from your system of set rules and strategy. Never make a decision based on a feeling or emotions like FOMO, fear of missing out. Always journal each trade's entry and exit criteria, and note the reason for buying the stock as well as the reason you would sell the stock. I'm not talking about the most obvious reason anyone would sell the stock, because it shot to the moon like a rocket ship. I want you to focus on the risks and how you could see this investment going sideways, and use those as the reasons you would sell to limit the amount of money you could potentially lose. The reason why I love all of this so much is because I can precisely quantify my risk in each trade to a dollar amount. I already know exactly how much I could lose if I were to end up losing on any particular investment or trade I make. If I don't like the risk versus reward profile, that definitely factors into whether or not I pull the trigger and move forward with the deal or not. It's important to fully understand how bad it could get if you are totally wrong. Always be aware of the worst outcome and analyze if it's worth it. The first step to setting your portfolio up in a way that protects you from risk is to use diversification in the structure of the portfolio. What is diversification, you ask? Not having all your eggs in one basket. You want to own stocks in different industries and sectors of business. Say for some reason you only bought bank stocks. Banks have lots of money in the vaults, right? Seems like a sure bet. But what if there is a major banking crisis and everyone floods to the banks to get their money out all at once? Due to fractional banking, it is not possible for every single person to get all of their money out at once. This would cause the banks who could not pay its depositors their money back to close and go bankrupt. If you owned only bank stocks, this would completely tank your portfolio and years of work and savings. The components to a balanced, diversified portfolio are used the VGD strategy: one value stock, one growth stock, and one dividend stock. 50% of the capital to individual stocks utilizing the VGD strategy: one value stock, one growth stock, and one dividend stock. After you reach 100K in portfolio size, you can add another value, growth, dividend stock. 500K, add another one of each, and so on. 16.6% of the portfolio size and capital to a value stock. A value stock is a stock with a low price relative to the company's financial performance. 16.6% of the portfolio size and capital to a growth stock. A growth stock is a fast-growing company that beats market average. 16.6% of the portfolio size and capital to a dividend stock. A dividend stock is a stock that pays dividends. These percentages and ratios can be adjusted depending on your personal risk tolerance and what period of life you are in. Lower risk would mean you hold more index funds and cash or bonds. The younger you are, you can take more risk by having larger positions in individual stocks that will be more volatile in the short term, but over the long term could generate a higher return on capital, 30 to 40% of the portfolio size and capital, to an index fund. Having the majority of your capital in an index fund when the market drops minimizes the drop of value in your portfolio, because these funds are controlled by algorithmic trading programs, or AI, that is highly advanced with its capability of making the right buys and sells at specific times to balance the value of the index fund. The best index funds are Vanguard index funds. They have the lowest management fees. An alternative to this Vanguard index is SPX or SPI, which is 1/10 the size of SPX, when stocks are all overvalued and there is capital and savings to deploy. SH is an index that shorts the market. When the market is high, SH will be cheap. As the market drops, selling this position will generate a good return that can be used to then buy stock, 10 to 20% in cash. This is for either starting a new position when a stock meets all the buying criteria, or if one of the stocks I own is trading below the 50-day moving average and I want to increase my position size. Always have some cash for opportunities. Let's talk about taxes and what this means for investors. When you buy stocks, you're not immediately taxed. Tax implications generally arise when you sell the stocks or receive dividends. Here is a breakdown of the key tax considerations. Capital gains tax is applied to the profit you make when you sell stocks for more than you paid for them. The tax rate depends on how long you held the stock. Short-term capital gains. If you sell a stock after holding it for 1 year or less, the gains are considered short-term and are taxed at your ordinary income tax rate. Long-term capital gains. If you sell a stock after holding it for more than 1 year, the gains are considered long-term and are taxed at a lower rate, which can be 0%, 15%, or 20% depending on your income. Dividends are payments made by a corporation to its shareholders, usually from profits. Dividends can be qualified or non-qualified. Qualified dividends. These are taxed at the long-term capital gains rate, which is lower than ordinary income tax rates. Non-qualified dividends. These are taxed at your ordinary income tax rate. Other considerations: wash sale. Rule: if you sell a stock at a loss and buy the same stock, or a substantially identical one, within 30 days before or after the sale, you cannot claim the loss for tax purposes. The loss is added to the cost basis of the new stock. Net investment income tax, NIIT. High-income individuals may be subject to an additional 3.8% tax on investment income, including capital gains and dividends. State taxes. Some states also tax capital gains and dividends, and the rates and rules can vary significantly from federal taxes. Time to recap. First, we talked about rules or systems. Second, we touched on structured diversification, value stocks, growth stocks, dividend stocks, index funds, cash on hand. Third, we spoke briefly about taxes. I will soon put out a final video that talks about the advanced concepts to long-term investing. We will go more in depth on how to analyze value stocks, growth stocks, and dividend stocks, as well as hedging your positions by utilizing option contracts as insurance on your stocks in case they do drop. It's really fascinating because if done correctly, it's possible to make money as the stocks you own drop. If the economic conditions are getting risky, there is a strategy that allows one to buy insurance for those stocks in the form of options contracts. There are ways to do this that are super cheap or even free to do. Please like and subscribe.